Alright, ladies and gentlemen, let's dive headfirst into the economic chaos Japan finds itself in right now. Another day, another bewildering dance between the Bank of Japan, BOJ, the yen, and inflation that keeps spiraling just out of control. It's like Japan's central bank is playing a very dangerous game of musical chairs, except instead of chairs disappearing, it's opportunities for actual strategic policy interventions. But wait, let's not just stop there. Kazuo Ueda, the governor of the Bank of Japan, is out here telling us that he believes they have enough time to make a policy decision on interest rates, even as the yen continues its gradual free fall. This comes after the yen dropped to nearly a 3-month low against the US dollar, flirting with dangerous volatility levels. Ueda's recent speech has all but confirmed what we've already suspected: the BOJ isn't moving on interest rates at its upcoming meeting, scheduled for October 31st. That's right, Halloween, and trust me, the trick is on the Japanese economy. So, what exactly is going on in Japan's economy? How did we get here? And why is the BOJ playing it so cool, while everyone else is sweating bullets over this out-of-control currency depreciation? Let's break it down point by point, looking at the broader economic issues behind this situation. Let's start where most of us feel the pain directly: the yen. As of writing this, the yen is hovering around 151.8 against the dollar. It had dropped below 153 just days ago, setting off several alarm bells. Y'all, that's not just a number, it's reflective of a serious devaluation of Japan's currency over the months and even years. In fact, Japan's currency has weakened by about 20% just in the past year, a slide that directly impacts everything from import costs to inflation rates. You're probably wondering, how did we get here? Well, it's not just a single thing, but rather a perfect storm of weak domestic demand paired with a global interest rate disparity. While other major central banks, like the Fed, Federal Reserve in the US, have been aggressively hiking interest rates to combat inflation, Japan has taken a completely different approach. Japan's central bank has repeatedly emphasized ultra-loose monetary policies. Translation: super low interest rates with still no end in sight. At 0% or very close to it, Japan's interest rates, compared to America's core rates of over 5%, make the yen extremely unappealing to international investors. Investors, seeing more profitable ventures abroad, have been dumping the yen. Demand for the Japanese currency is weak, so it naturally depreciates. Now, a weak yen sounds great for exports, right? Japanese products become cheaper and more competitive on the world stage, which might benefit companies that ship goods overseas. However, the downside far outweighs this supposed benefit. Why? Because Japan is heavily reliant on imports for essential goods, particularly energy and food. A weaker yen means imported goods become much more expensive. Have you seen gas prices in Japan lately? Energy imports, most of which are priced in dollars, have become painfully expensive. All of this results in cost-push inflation. The prices of goods and services increase because businesses still need to cover their rising operating costs. Oh, but here's the kicker: wages in Japan haven't kept up with this inflationary surge. Japan has been notorious for its stagnant wage growth since the 1990s, a phenomenon that some call the lost decades. Salaries didn't rise during the 90s, haven't risen much since, and definitely haven't risen in any meaningful way over the last year while inflation spreads across the country. So, here's the situation: rising costs on imported goods, stagnant wages, and now, inflation is pinching people's purchasing power harder than ever. Feel the squeeze yet? And in the middle of all this? Kazuo Ueda telling us that we have time. Oh really, Mr. Ueda? While the yen is in free fall, inflation is marching onward, and citizens are feeling more broke by the day, the BOJ is dragging its feet. Rather than confronting the inflation risks directly by hiking interest rates or even offering a clear strategy, Ueda's strategy seems to be one of waiting and hoping that something changes elsewhere before taking action at home. What's causing this hesitancy? It turns out that Japan is caught in a long-standing dilemma. The BOJ feels trapped, obsessively focused on holding down yields and keeping interest rates ultra-low to support economic growth that hasn't lived up to their hyper-optimistic expectations for decades. A transition to higher rates risks choking growth further, especially if Japanese consumers, already not spending like they used to, tighten their wallets even more. Let's talk about why the BOJ's wait-and-watch policy is a disaster in the making. They are waiting on clear signs like data showing that inflation has embedded itself deeply in the economy to consider hiking interest rates. This is cognitive dissonance at its finest. Inflation is here. As of September 2023, Japan's core inflation remains above the target of 2%, hitting 3.1% to be exact, a level not seen since the early 90s. While inflation over 3% may seem manageable compared to, say, Argentina's 100%, the real issue is that Japan is experiencing bad inflation. This isn't a result of booming demand or a flourishing economy. Instead, it's driven by the fact that everything's becoming more expensive while wages refuse to budge. There's no wage price spiral, just more cost pressure on everyday citizens. Governor Ueda is afraid to raise rates because he fears a hit to growth, but guess what? In the long run, not raising rates at all might mean even more hurt for Japan's underperforming economy. Eventually, if inflation expectations become unanchored, the pain will only be greater down the line. Now why bring up the US economy? Well, in his statement, Ueda made an interesting comment about the Ueda that Japan needs to closely monitor the global economic dynamics, as much of Japan's inflation meddling is done at the mercy of global factors. What Ueda is referring to here is the U.S. debt situation, interest rates, and possibly the upcoming 2024 U.S. presidential election. The U.S. Federal Reserve has been hiking rates aggressively, to a more recent 5.25%, 5.50% range, to tackle its own inflation problems. This has placed a huge upward pressure on the dollar, making the yen look even weaker by comparison. But here's the thing, if the US economy falters, which is not unthinkable given the massive fiscal deficits, political instability with potential shutdowns, and a presidential election looming, Japan could suddenly face two unwelcome scenarios at once. Either 1. UDA's growth slows down, leading to contagion effects that hit Japan even harder, triggering weaker global demand for Japanese exports. 2. Or, shockingly, the US economy continues to boom, forcing the Fed to keep rates high for longer, thereby pushing the yen down even further. For Japan, neither of these outcomes is good news. The general market consensus, backed by surveys like Bloomberg's, is that Japan is likely to wait until December or January to finally consider raising interest rates. If you remember, Japan has had very minimal incremental rate rises since the 1990s, the opposite of what we've seen in the US or Europe. Analysts predict that as long as there isn't a dramatic shift in international dynamics such as oil prices skyrocketing or the US running into a political crisis, BOJ might finally make its first substantial hike by early 2024. At that point, this whole interest rate disparity will have become so large that BOJ will be forced to act to stabilize the yen. Yet, by then, it may be too late. A delayed reaction risks causing greater inflationary risks down the road, all while continuing to compress consumer sentiment domestically. By maintaining ultra-loose policies while inflation mounts, the BOJ effectively risks what we call in economics stagflation, a dangerous mix of high inflation, low economic growth, and persistent unemployment issues. When Finance Minister Katsunobu Kato warns about the extreme volatility of the yen, he's not just commenting on typical currency fluctuations. His pointed remarks during the G20 meeting signal that Japan is inching closer to intervention-level territory. And let's be honest, yen intervention is not a foreign concept for Japan. In 2022, as the yen fell past a 24-year low, the Japanese government intervened with direct market actions to prop up the currency. It wasn't the first time Japan had to do this, and it likely won't be the last, given the severity of the current devaluation. Now, here's where the potential double-edged sword of intervention cuts the deepest. While the government can intervene in the short term to stabilize the yen, such efforts tend to be costly and, in many cases, only temporarily effective. Any intervention typically involves selling off yen reserves or purchasing large amounts of foreign currency to offset the depreciation, which can work for a while but doesn't address the root issue. What's the underlying problem? It all comes back to Japan's out-of-sync interest rate policy. When Governor Ueda insists that they have time before deciding on rate hikes, it essentially undercuts any attempts at long-term currency stabilization. You can't permanently fight a booming dollar and sliding yen if you're not prepared to tackle the interest rate disparity head-on. In essence, Kato's subtle panic hints at the necessity for drastic actions, be it market intervention or, more likely, policy shifts that would increase interest rates at BOJ. It's worth noting that market analysts and economists are watching Tokyo's moves closely, particularly for signs of coordinated interventions. With the yen weakening and inflation eating away at domestic savings, Japan could be faced with an all-or-nothing gamble if the BOJ continues on its current path of inaction toward interest rates. Now, let's zoom out and focus on the global fallout of Japan's economic strategy. The Japan you're seeing today doesn't live in isolation. In the world of economics, one country's monetary decisions often set off chain reactions, and Japan's actions or lack thereof are important for reasons that stretch beyond just domestic concerns. For starters, when Japan continues to keep its interest rates ultra-low, it artificially lowers the cost of capital. This has profound effects on international investors, who generally engage in something called the carry trade. What's the carry trade? Simple. Investors borrow in a currency with low interest rates, like the yen, and use that borrowed capital to invest in higher-yielding currencies, such as the US dollar. This inflates prices for certain assets abroad, contributing to bubbles in foreign markets, particularly in the bond and real estate sectors. While this strategy may look appealing on the surface, here's where the danger lies for global financial systems. Any sharp shift in Japan's interest rates, if and when it happens, could cause a sudden surge in the yen, forcing investors to quickly reverse their carry trade operations. The ensuing rush to exit could send shock waves through international financial markets, wreaking havoc on the very foundations of global investment strategies. And let's not forget that Japan holds one of the largest foreign reserves in the world, and it's a top creditor nation. This gives Tokyo significant leverage in influencing global bond and treasury markets, especially in the United States. In fact, Japan holds the biggest share of U.S. Treasury bonds globally, second only to China. If Japan shifts major strategies in response to economic pressures, it could trigger a revaluation of bonds across several major markets. In plain English, if Japan's loose policy ends abruptly, you might see ripples in your 401k or retirement fund even if you're sitting in New York, London, or Sydney. Remember when Kazuo Ueda cryptically hinted at the US presidential election as a variable in Japan's monetary policy decision-making? Yes, you heard that right, the outcome of America's 2024 election is a key piece of the puzzle behind Japan's economic strategy. Why is this? Japan's economy is deeply intertwined with US monetary and fiscal policy. With the US continuing to aggressively raise rates, from keeping the US economy relatively hot post-pandemic to managing modern inflationary pressures, the dollar strengthens, putting added pressure on the yen. That's economics 101 for you. Higher US interest rates equals stronger dollar equals weaker yen. But here's where it gets interesting. The 2024 US presidential election could shake up this dynamic. Two potential outcomes loom on the horizon. 1. If the Democrats remain in power, i.e., Joe Biden re-election, there's a good chance that current monetary policies tied to fiscal expansion and higher government spending will remain in place. That means the dollar will likely remain high, pushing Japan into a corner if the BOJ doesn't adjust its rates accordingly. 2. However, if a Republican candidate wins, especially one inclined toward populist economic policies like lower government spending or reduced federal debt, the US dollar could rapidly weaken. This could alleviate some pressure on the yen temporarily, but here's the wild card: geopolitical tensions and trade relations under a new administration could make it harder for Japan to balance diplomatic and economic priorities, forcing quick and, frankly, destabilizing policy shifts in Tokyo. In both scenarios, Japan is heavily dependent on geopolitical occurrences well beyond its control. This isn't just noise from the global economy. Ueda's policy choices impact every corner of Japan's economic fabric, from trade and exports to currency valuation and inflation management. Okay, let's tie this all back to the core issue: the risk of stagflation in Japan. What is stagflation? It's when an economy experiences high inflation, low growth, and high unemployment, all at the same time. And guess what? Japan is charting a dangerous course to this exact scenario if the BOJ doesn't reverse its passive stance soon enough. As of 2024, Japan's core inflation numbers are hovering around 3%, with energy and food prices driving most of that rise, a direct consequence of the weakening yen. All while GDP growth remains tepid at best. For instance, annualized GDP growth in the second quarter of 2023 was revised down to 4.8%, primarily fueled by one-off external exports, but underlying domestic demand remains weak. You've got rising costs squeezing both businesses and consumers, and yet wages are stagnating. Unemployment, while low officially, could start climbing if inflation continues unchecked and companies begin slashing operational costs to cope. In fact, during the last major inflationary period, the 1990s, Japan did indeed face a long-term stagnation that it couldn't shake. Experts fear that Japan risks drifting into something similar today, but with inflation actively eating away at any small nominal gains from what little economic activity there is. Japan has a deflationary psychology, where consumers are cautious with their spending habits, and companies hesitate to raise wages or prices for fear of eroding their customer base. And now, couple that with rising inflation rates caused by external factors such as weakening currency and expensive imports, and we've got a domestic recipe for a stagflationary environment. Let's think about the broader ripple effects one more time. Japan's public debt is already sky-high, sitting over 260% of GDP. Think about that. In an environment where inflation increases borrowing costs over time but growth stagnates, you're essentially on a collision course with financial disaster. Interest rate hikes, when they eventually come, risk spooking companies and consumers alike. Business investments already sluggish in Japan could plummet even further. In the resulting economic contraction, unemployment could rise, leading to economic paralysis under stagflation conditions. So, as Japan's policymakers sit in their ivory towers, painstakingly deliberating on when they should finally hike rates, the truth is, they're playing a dangerous waiting game. What we've seen so far is a central bank caught between the fear of spooking growth and the reality of rising inflation fueled by a weakening yen. Japan's over-reliance on imported goods, vulnerable labor markets, and exposure to global geopolitical risks only adds to the cocktail of uncertainty. If Kazuo Ueda's hesitancy to act continues, Japan may find itself dealing not just with currency chaos but also with a perfect storm of long-term stagflation with lower growth, persistently high inflation, and zero wage growth. Let's be clear here, the band-aid solutions offered so far are running out of time. The BOJ's failure to act decisively on interest rates does nothing to stabilize Japan's vastly chaotic economic situation or its struggling middle class. By the time BOJ finally takes action, likely in late 2023 or early 2024, the deep-seated issues in Japan's economy may have compounded to the point where raising rates will no longer suffice. Folks, the clock's ticking on Japan's strategy of economically playing dead while inflation, currency, and global dynamics rage on. The BOJ needs to wake up.